Welcome to my channel. I'm Scott, and in this video I'm going to walk you through a process of valuing NVIDIA stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Let's get started with the model. This is a large cap company, 1.3 trillion market cap. They're trading at $5.28 a share and they have 2.5 billion shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future and then you discount those numbers back to today's value. That's what we're doing in this video, and free cash flow is cash flow from operations minus capital expenditures. Look at their growth from 4.7 billion to almost 18 billion in the trailing 12 months. I guess I'm the dumb one. I should have bought NVIDIA all along, but there never seems to be a good entry point. It's just so high, the stock price. Net income is the profit or loss on the income statement. It's revenue minus expenses. That's also grown a ton from 4.3 billion to 19 billion. Revenue is a sales for the company, and that's gone up 200% from 2021, 17 billion to 45 billion. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's 1.3 trillion. We discounted the numbers back to today using weighted average cost of capital. We get a value of the company of $1.1 trillion. We divide that by 2.5 billion shares. And we get a calculated stock price of $4.50. They're trading at $5.28, so they're trading at a 17% premium. It's a sell according to the model. My normal model had them valued at $200. I massaged the model to make the company more valuable. I gave them a lower whack from 10% down to 7%. I had their future growth pretty aggressive, a little more aggressive than the analysts. And I also assumed they'd be more profitable than the past. Not only would their revenue grow a lot, but their expenses would go down as a percent of their revenue. After doing all of that, it still seems overvalued. But the stock keeps going up, so maybe we should just buy and not worry about the fundamentals. There are 61 companies in the same industry as NVIDIA, and if they have a number in red, they're worse than the median. If they have a number in blue, they're better. NVIDIA, Broadcom, and Qualcomm are fabless. That means they design the semiconductor chips and outsource the manufacturing to other companies. So their CapEx is not nearly as much as Taiwan Semiconductor, which is a foundry. They do strictly manufacturing. Intel does both manufacturing and designing, so they're fabless and a foundry. But NVIDIA is so big, they do some manufacturing. That's why they spent 1.3 billion in CapEx. But a bulk of their manufacturing is outsourced, mostly to Taiwan Semiconductor. They have a good debt to equity ratio. For every dollar of equity, they have 30 cents of debt. A little worse than the median. They do pay a dividend, but it's really, really small. When you round it, it's 0.0%. But if you keep going out decimal points, you'll find a number in there somewhere. Their free cash flow is a little less than Broadcom. Maybe we should invest in Broadcom. That stock has also gone up a lot. NVIDIA is the biggest company in this industry. Taiwan was the biggest company for many years, back in 2019, 2020, and I think 2021. Back in the 90s and early 2000s, Intel was number one by far. They've fallen off a cliff, Intel. According to their price multiples, they do seem overvalued. They have a worse price to book, PE, price to free cash flow, and price to sales than the median. But their price to free cash flow is better than the average, because some companies like AMD have a really high price to free cash flow, which drag up the average. Look at United Microelectronics. They have the best price to book, PE, and price to sales of all these companies. NVIDIA generates the third most revenue. Number one is Taiwan Semiconductor. Intel was number one for many, many years, even up until last year. But Intel is now number 2. NVIDIA is number 3. And the reason people keep buying NVIDIA, look at their 5-year annual revenue growth rate, number 1 at 29%. AMD is 28%, not too far behind. And monolithic power is 27%. It's a really growing industry. Except Intel, they're going down. And Micron also is going down. Let's take a look at their most recent 10Q. This is as of 10/29/2023. We'll start off with their income statement. Look at their revenue. Last year was 5.9 billion. And for the 3 months ending 10/29/2023, it's 18 billion. They tripled their revenue, a 200% growth, 6 billion to 18 billion. Some people say 6 billion to 18 billion is 300% growth, but that's incorrect. It's 200% growth. Because say it was 6 billion to 12 billion, that's 100% growth because it doubled. It went up 100%. So 6 billion to 18 billion is 200%. Let's get a breakdown of the 18 billion so we know what it is. Of the 18 billion of revenue, 6 billion is in the US. That's their biggest country. Taiwan is pretty big at 4 billion. China, 4 billion. Singapore, 3 billion. And 750 million in the rest of the world. And it's gone up a lot in every category except the rest of the world. It's declined. But it tripled in the US, quadrupled in Taiwan, almost quadrupled in China, and went up more than 5 times in Singapore. Here's a different breakdown of their revenue. 14.5 billion is in data centers. That's their bread and butter. Gaming, 3 billion. Professional visualization, 400 million. Automotive, which should be growing in the future, 260 million. OEM, original equipment manufacturer, 73 million. You see here's their revenue growth. The 6 billion to the 18 billion is 206%. Look at their gross margin, 74%, up from 54%. Of the 18 billion of revenue, compute and networking, 14.6 billion. Graphics, 3.5 billion. Let's go back to the income statement. Below revenue is the cost of revenue. These are all the expenses directly related to generating the revenue, 4.7 billion. Gross profit, 13.4 billion, up from 3.2 billion. R&D is up a little bit, 2.3 billion. SG&A is up a little bit to 700 million. So total operating expenses, 3 billion. Operating income, 10 billion. Amazing margins. They received 234 million of interest on their investments. They paid 63 million of interest on their debt. Their income before taxes is 10.5 billion. Net income of 9.2 billion, up from 700 million. Look at their EPS, 375. Last year was 27 cents. And their shares outstanding declined a little bit. It was 2.48 billion last year. Now it's 2.46 billion this year. Really impressive income statement. Let's look at the balance sheet. Current assets of 33 billion. Current liabilities of 9 billion. 33 over 9. So their current ratio is above a 3. They have 5.5 billion of cash on their balance sheet, 12.8 billion of marketable securities. These are investments in corporate bonds, commercial paper, highly liquid, pretty safe investments. 8.3 billion of accounts receivables. This is when they sell product on credit, so their customers owe them that money. 4.8 billion of inventory and 1.3 billion of prepaid expenses. This is when a company makes an advance payment for a product or service that they're going to receive in the future. So current assets of 33 billion, up from 23 billion. Their total assets are 54 billion. They only have 4.4 billion of goodwill, so they do some acquisitions, not too much. Liabilities of 21 billion, up from 19 billion. Their biggest liability is long-term debt of 8.5 billion. Here's a breakdown of the 8.5 billion. They have a note of 1.25 billion. The interest rate is only 0.66%, and they have notes going out to 2040, 50, and 60. The interest rate is around 3.5%. They do have 9.7 billion of debt, but 1.24 billion is due within 12 months. 8.5 billion is due beyond 12 months. So here's the 8.5 billion in long term, and here's the 1.2 billion in short term. Because the assets and liabilities are broken out to current and non-current. Let's look at the equity section. The way you calculate equity, you take the assets 54 billion minus liabilities of 21 billion, and you get your equity, 33 billion. They raised 13 billion from selling their business, from selling common stock. They profited 20 billion from running their business. 20 billion is the sum of all their prior net incomes, minus the sum of the dividends they paid out. That's how profitable the company is historically. Let's take a look at the statement of cash flows. This is for the trailing 9 months. The first section is operating cash flow, 16.6 billion. This is how much cash the company generated from its operational business. Because remember, net income is your accounting profit or loss. It's not actual cash. You have to adjust for the non-cash items on the income statement. It's a lot higher than last year of 3.4 billion. In the investing section, they don't spend much in PP&E, only 800 million. Acquisitions, 83 million. And investments in other companies, 872 million. This 8 billion and 11 billion are just their investments in marketable securities. So it's just so they earn a little interest on the cash. Here's the financing section. They bought back 6.9 billion of their own stock. Last year was 8.8 billion. They paid down 1.25 billion of debt. We saw that note earlier when we looked at that long-term debt section. They paid 1.9 billion of taxes. These are taxes on restricted stock units. Stock for their employees, because they have to pay taxes on that. The stock is essentially free to them because they don't have to pay for it. It's their stock, but they do have to pay the taxes on it. They paid out 296 million of dividends. In their financing section, they had a cash outflow of 10 billion. Here's the stock price since they started trading in 99. So you can see pretty much from 99 up through 2016, it didn't really move too much. So imagine sitting on it for 17 years and then selling it because you didn't really make much money. But if you just only waited another 5 years, you could have been the richest person in your family. Even in 2016, it was trading below $20 a share. It finally broke through 100 in 2020, and it seemed overvalued at 100. And then when it went up past 300, it seemed really overvalued. Then it started coming down a lot, and I didn't think it would ever go back up again, but boy was I wrong. Look at this surge, well past 500. These are monthly candlesticks, and they're almost all green. They rarely have a bad month. I mean, there's really no logic to figuring it out. Imagine it's $2 trillion next year. We could have doubled our investment than sitting on all these other stocks making 5-10%. But I just can't do it. I can't buy it at 1.3 trillion. And look at this volume. Over 1 billion shares a month are traded. And the stock is so high and it gets that much trading activity. This is a big candlestick in May 2023. It opened a month at 278. It closed a month at 378. That's pretty funny. So it went up exactly 100 points, about 35-36%. And look how high the wick got. It was up to 419. So at the peak of the month, it was 419. But if you sold it this month thinking you made a ton of money, it was a bad sell because look at it now. It's over 500. It'll probably hit 600 in a couple of months. I think we missed the pullback. I know that's what a lot of people are saying. I'm waiting for a pullback, but you might be waiting forever. Let's look at the stock on Simply Wall Street. Its last price, 522, 1.2 trillion market cap, up 5.5% in the past week, up 230% in the past year. Let's see what they say about the company. NVIDIA provides graphics and networking solutions in the US, Taiwan, China, and internationally. The company's graphics segment offers GeForce GPUs for gaming and PCs, the GeForce Now game streaming service and related infrastructure, and solutions for gaming platforms. Quadro NVIDIA RTX GPUs for enterprise workstation graphics, vGPU software for cloud-based visual and virtual computing, automotive platforms for infotainment systems, and Omniverse software for building 3D designs and virtual worlds. Sounds like what Meta wants to do. Its computer networking segment provides data center platforms and systems for AI, HPC, and accelerated computing. You probably know AI means artificial intelligence. HPC is high performance computing. Mellanox networking and interconnect solutions, automotive AI cockpit, autonomous driving development agreements, and autonomous vehicle solutions. Cryptocurrency mining processors, Jetson for robotics and other embedded platforms, and NVIDIA AI enterprise and other software. The company's products are used in gaming, professional visualization, data center, and automotive markets. NVIDIA sells its products to OEMs, original device manufacturers, system builders, add-in board manufacturers, retailers, distributors, independent software vendors, internet and cloud service providers, automotive manufacturers, and tier 1 automotive suppliers, mapping companies, startups, and other ecosystem participants. They have a strategic collaboration with Kroger. They were founded in 93, 31 years ago in Santa Clara, California. Simply Wall Street is at 364. They say it's 43% overvalued. 48 analysts priced this stock at 658. They say it's undervalued. Their revenue back in 2013 was $4.28 billion. It grew a little bit over the next few years, up to $5.1 billion in 2016. It got up to $12 billion in 2018, took a dip in 2019 to $10 billion, then shot up to about $30 billion in 2022, down to $26 billion in April 2023. Then like a rocket ship, up to $45 billion currently. This is for the trailing 12 months, 10/28/2023. The forecast for their 2025 revenue is $90 billion, $108 billion for 2026. In my model, I use a higher growth than this, just to show you how overvalued the stock is. In 2013, they had no debt. They added a little in 2014. It peaked at $11.9 billion in 2021. It's down to $9.7 billion. But their equity is much higher than their debt, especially currently. Equity of $33 billion, debt of under $10 billion. And they always have more cash than debt, so it's almost like they're debt-free. The blue line is their equity, the green line is their cash. Their dividend yield in 2014 was 2%, and now they pay the lowest dividend. Of the companies that pay a dividend, I think they're the lowest, 0.03%. They've been paying a 4-cent dividend for several years now. These vertical lines are their quarterly dividend payments. Since 2018, they've been paying 4 cents a share. The CEO's annual salary is $1 million, total compensation $21 million. Their tenure as CEO is 31 years. You can see the insiders aren't too comfortable holding the stock. There's only sells, no buys. Over 800,000 insider shares have been sold in the past year. 2/3 of the company is held by institutions, 29% by the general public, and 4% by insiders. Their biggest shareholder is Vanguard at 8.25%, BlackRock at 7.25%, Fidelity at 5%, the CEO at 3.5%, T. Rowe Price 2.25%. This company was started by Thomas Rowe Price Jr. in 1937. He was really focused on active investing as opposed to passive. JP Morgan 1.1%, Morgan Stanley 2/3 of 1%, Eaton Vance 0.6%. When employee count goes up, that's a bullish sign. They went from 8,000 in 2013 to 26,000 in 2023. And the ticker trades in lots of places: Nasdaq, Xetra, Deutsche Börse, Mexican Bolsa, Swiss, Borsa Italiana, Wiener Bourse, Lima Bolsa, Bulgaria, Kazakhstan, BATS Europe, Buenos Aires, Sao Paulo Bolsa, and NEO. So let me know what you think. Give the video a like, subscribe, or comment below. If you'd like to get a custom valuation or just support the channel, you can become a member by clicking the link in the description below. Thanks for watching.